Death and taxes, the only two certainties in life, but only one should be something you worry about. In this video, I've got 7 strategies to beat capital gains taxes and lower your total tax bill. In fact, working with private wealth planning years ago, we were able to save one client over $1.2 billion in taxes just using these exact 7 steps. We're talking tax planning today on Let's Talk Money. Beat debt, make money, make your money work, creating the financial future you deserve. Let's Talk Money. Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, working in private wealth planning, I realized fast that it wasn't those big double-digit returns that matter most. The millionaires I worked with wanted those returns, but the very first question they always asked my team, how much can you save me on taxes? That is the number one, the most important thing for any investor. And this doesn't matter whether you've got $100 invested or $100 million. For example, I remember working with one client with an income of roughly $7 million. And this is 2014. So we're talking a top tax rate of almost 40% on their income and a $2.7 million tax bill just on the income. That's not even including any capital gains taxes and other investment income. By using the very ideas that I'm going to share with you in this video, we were able to knock $1.2 million off that total tax bill. This was by using some very easy tax planning ideas like tax loss harvesting, which lowered his capital gains tax to almost zero. We shifted his highest cash flow investments into tax-deferred accounts, and we took full advantage of business expenses. Now, I wanted to make this video a one-stop for everything taxes, so we're going to start with some very basic tax 101 stuff like how investments are taxed, capital gains, and some investments you can use to never pay taxes. I'll then reveal those 7 tax-saving ideas that are going to save you lots of money. I'll put a clickable index in the video description below if you want to jump forward, but please watch the entire video because just 15 minutes here is going to save you thousands of dollars or more at tax time. So the first question here is, how are investments taxed? And we'll see that there are actually 3 different types of investment taxes. The first one here is a big one, capital gains taxes. Now, buy low, sell high means you made money and Uncle Sam wants his cut. You owe taxes whenever you sell an investment for a profit. So this goes for anything from stocks to bonds, real estate, anything you sell for a profit. But the taxes you owe are going to depend on 2 factors, how long you held that investment and your income level. Now, any investments you hold for less than 365 days, so you buy a stock on maybe March 15th and then sell it before March 15th of the next year, these are taxed as short-term capital gains. Now, short-term capital gains are just added to your regular income and taxed at those rates. Now, this could be a potentially very high rate. We see here the 2020 income tax brackets, and those top earners, individuals making over $518,000 a year, or married couples making over $622,000 are paying 37% of their money they make over that level. They're paying that in taxes. So for example, if you're not married and you make $150,000 a year, you're going to be losing 24% of your short-term profits to those taxes. If you're married and making $340,000 jointly, your rate is at that 32% level. On the other hand, if you hold your investments for longer than that 365 days, any profits are taxed at a special rate as a long-term capital gains. Now here's the table for those rates, and again, your rate depends on your income as well. For individuals making less than $40,000 or couples making less than $80,000, you pay no capital gains taxes. Now that's a hugely important point, so I want to repeat it. If you're making less than that $80,000 a year, and this is your adjusted income, so you get that standard deductions on that, and the limit here is actually right around $100,000, but you're paying nothing in long-term capital gains. Your tax rate on these long-term profits goes up to 15% or 20% if you make a little bit more money, but never as high as those income tax rates. So just right here, you see that huge importance of planning. Okay, anytime you sell a stock, you need to be thinking, have I held this for at least 365 days? Now that doesn't necessarily mean you can't sell a stock that you hold for less than a year. There are reasons to sell a stock no matter what the tax bill is going to be. But if you can hold your winners for at least that 1-year period, you'll end up saving thousands of dollars in taxes. Now a second type of investment taxes are on dividends here, and these also fall into those 2 different categories. Qualified versus non-qualified dividends. I know the IRS isn't making it easy with all these different levels and stuff, but this one is actually easy to remember because it's a lot like those capital gains taxes. Qualified dividends are when you hold the stock for at least 60 days around the dividend date. Now that 60-day clock can be before or after the dividend. So if you're holding the shares for 59 days before the ex-dividend date and then through that day, you get that special qualified dividend tax rate. Now the taxes you pay on those qualified dividends are the same as the long-term capital gains rate, so I'll show that table again here. Remember though, you pay taxes on dividends you collect each and every year, not just when you sell the stock. So any dividends you receive, if you hold the stock for at least 60 days around that dividend date, you're going to pay either 0, 15%, or 20% next April, depending on your income. Non-qualified dividends. So if you receive a dividend on a stock and do not hold the shares for at least that 60-day period, these are going to be added to your income and taxed at those regular income tax rates. Now again, potentially much higher taxes on these, so you need to think long and hard about selling those dividend stocks, especially if you haven't held them for more than that 2 months. Now we need a special note here for foreign companies, okay? Anytime you own shares of a foreign company that pays dividends, your broker, the investing platform, is going to withhold a portion of those dividends for foreign taxes. You'll see this amount reported on your annual tax statement, and you can usually take that amount off on your U.S. taxes owed. One last type of investment taxes here before we get to that special type of investment where you might never have to pay taxes, and then those 7 ways to lower your tax bill. Here we're talking about taxes on interest income. Now you're going to receive interest income on a few common investments, including savings accounts, CDs, bonds, and peer-to-peer lending. Basically, anytime you get interest from one of these, even if it's just a few bucks, you're going to get a 1099 interest form and you're going to owe taxes on that amount. Now, interest income is taxed as regular income, and there's really no way of getting those lower long-term rates on these, so the rate that you could pay could be up to 37% if you're in that top tax bracket. So here on one of those 7 strategies that we'll talk about, using tax-deferred accounts, it's going to be super important to save money on these. And one last special type of investment I wanted to point out before we get to those 7 strategies, and I bring this one up because it's such a huge opportunity that's really too often missed or even avoided by investors. Here I'm talking about master limited partnerships, or MLPs. Now these are special companies usually holding oil and gas pipelines that pay out a majority of their profits as dividends. So with MLPs, you're going to be getting a dividend yield as high as 12%, but there's also a huge tax break built into how these are set up. The majority of your dividend isn't technically a dividend. It's counted as a return of your investment. Now that's going to mean you don't pay taxes every year on this like you do other dividend stocks. And here's the best part. If these investments pass through to your estate, so your heirs get them in an estate, they never have to pay taxes on the dividends you collected. It's going to be confusing a little bit at first, so I created a video on MLPs, that special tax break that investors get, and how to pick these cash flow stocks. I'll leave a link to that in the description below. Make sure you check that out because these are amazing investments. Now on to those 7 strategies to save on your taxes, and thank you for sticking around with me here. I think more than just knowing these 7 tax strategies, knowing the tax basics is so important, so I wanted to include it in this video. First though, as an informal poll of the nation, I wanted to get your opinion. Which type of taxes do you hate the most? So we got taxes on your investments, income taxes, that sales tax you pay every time you buy something, or the property taxes. Which of these do you hate paying most? Scroll down and tell me in the comments below. Our first of the 7 tax saving tips is called tax loss harvesting, and with this one you can even lower your regular income taxes. The IRS allows you to offset your capital gains with losses. So for example, if you sell a stock and made $500 total profit, but then you sell another stock for a $500 loss, they'd cancel out and you would owe nothing on capital gains tax. But since there's 2 types of capital gains, so those short-term and long-term, there are 2 types of tax loss harvesting. Now, all your losses on those long-term investments are going to go to offset the long-term gains first. If there's losses left after offsetting all those gains, then they're applied to the short-term gains as well. The remainder, whether it's a long-term or a short-term gain or a loss, that's going to be applied to your tax rates that we talked about earlier for your tax bill. What's even better here, though, is that if your losses totally wipe out your gains, you can take up to $3,000 in losses against your regular income in each year. For someone at that 37% tax rate, that's going to save you over $1,000 in regular income taxes. Now you can only write off that income to that max of $3,000 in losses in any single year, but if you have more, say you got sucked into the Bitcoin and sold at a loss of $20,000, you can take that $3,000 off and lower your income this year, then carry the other $17,000 into the next year and offset any capital gains that you report then. So putting this in a strategy, what you want to do is towards the end of each year, maybe November or December, look through your investments and calculate all the unrealized profits and then the losses. Then you strategically sell out of your investments. If you've already booked some profits from stocks you sold, then maybe you look for a few losers to sell to offset those gains that you'd have to report. Nobody likes taking a loss on an investment, but this strategy at least makes a little lemonade out of those lemons. And selling those losing investments, though, that doesn't mean that you can't get back in and enjoy an eventual rebound. The IRS just says that you cannot buy the same or an identical investment within 30 days of taking that tax loss, but you can always wait the 30 days and then get back into that exact same stock. What I like to do is selling the stock, invest the money into a sector ETF, so I still get that upside from similar stocks in that same sector. Then I can invest the money back into that same stock if I want to after that 30 days is up. I know there is a lot to keep track on this one, and a lot of those other strategies we'll talk about as well, but just about any tax software is going to make this really easy. I use TurboTax because it's got the features that I need for my home business and the investments. The software makes it really easy reporting different investments, losses and gains, and then keeping track of everything. TurboTax is free to file federal and state, and it's totally free to start, only paying after you see how much you're going to get back, so I'll leave a link to that in the video description below. Another great tax strategy, and everyone in the nation has heard me talk about this one, is putting your cash flow investments in retirement accounts. So we talked about this with dividends earlier, right? Anything that returns a cash flow during the year, you're going to owe taxes on that, and you need to protect it. For example, take a look at this chart. If you invested $5,000 into two accounts, one invested in dividends for an 8% annual cash return with taxes paid every single year on those dividends, the other account, same 8% annual return, but no taxes until you withdrew the money in 30 years. It's a $10,000 difference. Keep those dividends in your account, reinvesting in them, earning more money, and not paying a chunk to Uncle Sam every year. The same goes here for interest income investments like those bonds and peer-to-peer lending. Actually, even more so on these because these are going to be taxed to those higher income rates. So any kind of cash flow investments need to be invested through an IRA or a Roth account. And we'll talk more about these types of accounts later, but this is really where your dividend stocks need to go. Since you're limited to investing $6,000 into these accounts each year, you really need to prioritize the investments you buy with that money. If you're investing in individual bonds or peer-to-peer lending, so those interest income investments, those should be your top priority into an IRA. Now, if you're only investing in dividend stocks, so not any of those interest income investments, then put your highest yielding stocks in your IRA or your Roth account. Even at that lower tax rate of 20% on qualified dividends, if you earn, let's say, 6% a year on the dividend stock and you put those into an IRA, you're saving $72 a year and able to make more money on that every single year until retirement. Our third tax strategy, and this is going to be one of the biggest, is taking advantage of business deductions. Now, this one is going to be more complicated, but if you want to know, this right here is where the rich really make their tax savings. You don't need to create some formal company or anything like that. If you're selling a product or some kind of service, or if you just have an online business with a website, all of your income and expenses are going to flow through to your personal income taxes. So you're going to put all your sales and expenses on Schedule C of your income taxes. And again, this is super easy to do with any tax software like TaxAct or TurboTax. There are a lot of expenses you can take that zero out your business taxes and even can save you money on regular income taxes. Some examples here are going to be trips you take where you work on your business, any advertising or marketing you do, office equipment, your laptop, any other office supplies. You can even take a portion of your home utilities and property taxes off as an expense if you work from home. There are some great expenses here, like being able to write off part of your vacation costs if you do a little work while you're out, and taking some of your car costs off of your income if you use that for work. Now, obviously, this isn't something you do only for the tax break, but turn that hobby into a small side hustle, make a little extra money, and you can actually save taxes on your other income as well. That's because sometimes your expenses are going to be higher than your sales for the year. Okay, you can take this small business loss, though, those expenses, and take them against your regular income to lower your taxes there. And then if you don't have any taxes that you owe this year, you can get a refund on taxes you paid over the last 2 years, or take them forward and not have to pay taxes in subsequent years. The IRS generally just says that you need to make a profit in 3 out of about 5 years to be considered a business. But if you're genuinely running this thing, even just a few hours a week, you can really save a lot of money on your taxes. Now, one of my favorite ways to save on taxes, and this is one of the biggest for the wealthy, is real estate depreciation. As your income grows and you get into those higher tax brackets, investing directly in real estate really starts to make sense because of those huge depreciation write-offs. Depreciation is just an estimate for the loss of value in an asset over time. They say that things like computers, cars, even real estate loses its value because it's not going to last forever. Now, the IRS says you can take the value that you paid for one of these or any money you put back into it for capital improvements, spread it out over 27 and a half years for residential property or 39 years for commercial property, and then take that amount off your income each year to compensate you for that supposedly lost value. So for example, if I paid $300,000 for a rental property and the land is valued at $75,000 for property taxes, the building is worth $225,000 for taxes. Now that's an important point because you don't depreciate land. You can only depreciate the building value. So I divide that $225,000 by 27 and a half years, which is the useful life estimate for residential real estate. So $8,181 in depreciation expense here. I can take that off the rental income each and every year. Now that means I take my gross rent minus all the expenses and minus that $8,181 a year. That's the amount that I report as income and have to pay taxes on. So again, if you're in that 37% tax bracket, being able to take off more than $8,000 a year in depreciation, that's going to save you over $3,000 a year in taxes. Remember, depreciation isn't actually something you have to pay. Now, that property isn't really dropping in value. In fact, the value is probably increasing a little bit. Depreciation is just an accounting trick the government allows. It means real estate is one of the best ways to avoid taxes. An easier tax saving tip for a lot of people is going to be to take advantage of an IRA or a Roth IRA. Now we touched on these earlier, and these have got to be on everyone's list to save money on taxes. These are two special investing accounts with huge tax benefits. So first, you get to take any money deposited into an IRA off your current year's income, so an immediate tax break, and you never pay taxes on gains or dividends until you withdraw the money in retirement. With a Roth IRA, you pay your taxes on the money you invest now, but you never pay taxes while the money is in the account or when you take it out in retirement. Now listen to that last part again, because this is why I love Roth IRAs and why everyone should be using them. Unlike that IRA account where you pay taxes on everything you're going to withdraw, you never pay taxes on your returns from a Roth account. You already paid taxes on the money you deposited, so of course that comes out tax-free. But all the money you made on investments, completely tax-free forever. Now I'm going to link to a detailed video of the pros and cons of these two types of investment accounts in the description below. I'm also sharing in that video a strategy of getting the best from both an IRA and a Roth. As great as those IRA accounts are, you can save even more taxes by investing in a 401k plan. I love my IRA accounts, but you can only protect about $6,000 a year from the tax man. Protecting more of your income means using that 401k plan, either one from your employer or a solo 401k that you can set up with your own business. You can contribute up to $19,500 of your income into a 401k each year, and your employer can match some of that for up to $57,000 in combined contributions. That's going to save a lot of money come tax time, and can mean a lot of small business owners aren't going to pay anything in taxes. Definitely look into your company's 401k match program if they have one, and if you've started that side hustle like we talked about earlier, you can open a solo 401k on any investing site like E-Trade to contribute as a business owner and as an employee. Now, one of the least used tax breaks are special savings accounts like the health savings account, that's HSA, and the flexible spending account, or FSA. I love these because it's money you're going to be spending anyway. Why not get a tax break while you do it? Now, a health savings account, or an HSA, can be set up through work or most banks, and it's pre-tax money that you deposit to cover your medical expenses. Now, you earn interest on that money that you deposit, and it comes out completely tax-free to pay those expenses. The trick for an HSA is that you also have to have a high-deductible health plan, an HDHP, which is just health insurance with a minimum deductible of at least $2,700 for a family plan. Now, the upside here, though, is these plans are usually much cheaper than other insurance because of that higher deductible. So not only are you saving money on your taxes by not paying income taxes on that money that you spend for medical costs, you also save on your insurance. Now, a flexible spending account, or an FSA, is a lot like the HSA, but you can also use this one to pay for childcare costs. You can deposit up to $2,750 a year into your FSA. Take that amount off your income so you're not paying taxes on it, and use that for your childcare expenses. While money in an HSA just keeps earning interest and growing until you need it, you do need to use any FSA funds during that year period, but there are a lot of approved expenses here, so it's never been a problem for my family. Click on the video to the right for a complete 12-month investing plan, including how much to invest each month to build a $1,000 portfolio in just 1 year. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.